Most traders lose money, not because the market is impossible to figure out, but because they trade without rules. They jump in based on feelings, not logic. In this video, I'm going to show you one simple and profitable Forex strategy. I'll give you the exact things you must do and the exact things you must not do if you want to become a consistent, profitable trader. Before we dive into any strategy, you have to understand one fundamental rule of the market. Price moves from liquidity to liquidity. Big institutions, the ones that actually move the market, aren't guessing. They are strategically targeting areas where stop losses and pending orders are clustered the previous highs and lows. We are going to focus on the most liquid pairs Eurist, G-Post, and gold. And we only trade during the most active sessions, London and New York. For our strategy, we'll use the 15-minute chart to understand the bigger picture, and the 5-minute or 1-minute chart for our precise entry. Alright, let's get into the strategy itself. It's a 3-step process: liquidity sweep, followed by a market structure shift, and finally, a clean entry candle. First, on the 15-minute chart, we identify the trend. Is the market making higher highs and higher lows? That's an uptrend, so we have a buy bias. Is it making lower highs and lower lows? That's a downtrend, giving us a sell bias. The golden rule here is simple: only trade in the direction of the trend. Don't fight the current. Next, we drop down to the 5-minute chart and wait patiently. We're looking for a liquidity sweep. For a buy setup, we want to see the price dip down and sweep the liquidity resting below a previous low. This is where most retail traders get stopped out. For a sell setup, we wait for the price to spike up and sweep the liquidity above a previous high. This move is designed to trap traders on the wrong side. After the liquidity is taken, we need confirmation. This comes from a market structure shift. If we're looking for a buy after the sweep of the low, we need to see the price rally and break decisively above the previous lower high. For a sell, after the high is swept, we need a strong break below the previous higher low. Let me be clear, no structure shift means no trade. This is non-negotiable. Finally, our entry. Once the structure shifts, we look for our entry candle on the 1-minute or 5-minute chart. We want to see a strong rejection candle, an engulfing candle, or a pin bar forming at a key level. This is our signal to enter the trade. Place your stop loss just below the low of the liquidity sweep for a buy, or just above the high of the sweep for a sell. Our target is the next significant high or low, making sure we have at least a 1-to-2 risk-to-reward ratio. Now, if you want to achieve consistency, there are things you must do every single day. First, focus on quality, not quantity. Aim for just 1 or 2 high-probability setups per session. Always use a stop loss. It's your lifeline. Risk only 1% or less of your account on any single trade. Journal every trade you take: the good, the bad, and the ugly. This is how you learn. Be patient and wait for all your rules to align before you click that button. Just as important are the things you must avoid. These are the mistakes that will destroy your account. Do not revenge trade after a loss. Do not overtrade out of boredom or greed. Never, ever move your stop loss further away to give the trade more room. Don't trade without a clear directional bias from your higher time frame. Don't chase green or red candles. And most importantly, do not trade when you are emotional, tired, or stressed. Remember, Forex trading is not about winning every single trade. It's about discipline, patience, and strict risk control. One good, well-executed trade is infinitely better than 10 impulsive, bad ones. Your job is to follow your rules, respect your risk, and let the probabilities work in your favor over time. If you found this strategy helpful and want to see more content like this, make sure to follow, like, and save this video for later. Thanks for watching.